Depreciation. About depreciation, I have already explained you in my previous segments. I mean to say when I was teaching you about my accounting equation. So let me repeat the meaning of depreciation. Depreciation means reduction in the value of long-term asset is called depreciation. Be careful about the definition. Reduction in the value means there must be decrease in the value of asset. Which asset? Long-term asset. You know it. There are two types of assets, long-term and short-term. Depreciation is always on long-term asset. I mean to say fixed assets. Be careful. There are so many types of assets. Physical assets and intangible assets, etc. There cannot be any depreciation on intangible assets. You might be getting confused. What is intangible assets? I will explain you in details about the intangible assets. I mean to say about goodwill, patent rights, etc. There is no depreciation in goodwill or any other intangible asset. Basically, depreciation means wear and tear, means reduction in the value of asset due to wear and tear, change of fashion, or change of technology. You know, for example, if you buy computer today for ₹50,000 and after 5 years, if you go to the market to sell it, are you sure you will be able to sell it for ₹50,000? No, because so many parts of the computer has gone out. Maybe they have become obsolete. And secondly, when you bought the computer, it was looking very good. It was looking new. Now it doesn't look so nice. So it's all due to wear and tear. Let me take one more example. Suppose today you buy one computer for ₹50,000 and you keep it packed. I mean to say you never ever use it. And after 5 years, if you go to the market to sell it, are you sure you'll be able to sell it for ₹50,000? No, because after 5 years, there will be new models, new technology, and there will be new types of computers will be available in the market. You won't be able to sell it for ₹50,000. Maybe you are able to sell it only for ₹10,000. So that reduction of ₹40,000 of 40,000 over 5 years, that will be called depreciation. But it's not due to wear and tear. So there are so many reasons of decrease in the value of fixed assets. One thing I would like to make it clear, that if there is any decrease in the value of fixed assets due to fire, damage or accident, you can't call it depreciation. Depreciation is always only due to wear and tear, change of fashion, change of technology, etc. One thing more, you must have noticed that I have been using different words in my explanation. Sometimes I use firm, sometimes I use company, sometimes I use organization. At this stage, there is no difference among firm, company, organization or venture, etc. for you. I will go into details in the upcoming episodes. So for you, whether it's firm or company or organization, it's one and the same thing for you. Let me remind you about the accounting cycle again. Under this accounting cycle, all the transactions are converted into journal entry. On the basis of journal entry, ledger posting is done, and on the basis of ledger posting, trial balance is prepared, and on the basis of trial balance, final accounts are prepared. And final accounts contain income statement and balance sheet. Income statement tells us about the profit made by the firm during the year, and balance sheet tells us about the financial position of the company at the end of the year. Financial position means the position of assets and liabilities of the firm. Let's take one practical question. A starts business with cash rupees 5,000, purchased goods rupees 1,000, sold goods costing rupees 800, for rupees 3,000, purchased furniture rupees 2,000, depreciation on furniture rupees 500, closing stock as on 31st March 2013 rupees 200. So the journal entry will be cash account debit to capital account 5,000 rupees and purchased goods rupees 1,000, and the journal entry will be purchases account debit to cash account, and the next journal entry is sold goods costing rupees 800 for rupees 3,000, and the journal entry will be cash account debit to sales account rupees 3,000. Please be careful. To make the journal entry out of the transaction means to find out debit and credit aspect of the transaction, and we are doing the same thing. Now the next transaction is purchased furniture rupees 2,000. Furniture is an asset for us. So we have bought the furniture and we have paid the cash immediately. This is the cash transaction. So let's go to the table of option. On debit side, debit all expenses and losses. To buy any asset is not expense, it's not a loss. Move to the next option. Debit what comes in. Has anything come in the firm? Yes. Furniture has come in the firm. So write down furniture. Now go to the credit side. Credit all incomes and gain. To buy the asset, to buy the furniture is not an income, it's not a gain. Now move to the next option. Credit what goes out. Anything has gone out? Yes, cash has gone out. So write down cash. So we have found the debit, we have found the credit aspect of this transaction. Use the suffix of account on both sides, and on credit side, I mean to say for cash account, write down to as a prefix. So on debit side, furniture account, on credit side, to cash account. Come to the format of journal entry. The journal entry will be furniture account debit to cash account rupees 2,000. Now depreciation on furniture rupees 500. You know, depreciation means reduction in the value of fixed assets. It's a loss for the firm because our value of furniture has come down. So let's make the journal entry on debit side. Debit all expenses and losses. Is it expense or loss? Yes. And the name of this expense is depreciation. So you write down on debit side, depreciation. Come to the credit side. Credit all incomes and gains. Is there any income due to depreciation? No, not at all. Go to the next option. Credit what goes out. Has anything gone out? Anything has not gone out physically, but there is a reduction in the value of furniture. Means the value of asset has gone out. Means the value of asset has decreased. So we'll write down furniture. So this transaction may be a bit confusing for you. In the upcoming segment, we'll be taking up the chapter depreciation. It will be a full-fledged chapter on depreciation. So I'll be able to explain you the full details why we are going to credit furniture account. I'll be able to explain you in that situation. So on debit side, depreciation, and on credit side, furniture. Or we can say depreciation account to furniture account. So come to the journal entries. That will be depreciation account debit 500 rupees to furniture account 500 rupees.